pay 17.6 billion baht in back taxes from the 2006 sale of ShinCorp shares. That's more than just a technical legal tax decision. In the end, it's a political, legal, and symbolic moment that rewrites the trajectory of a case long described as unwinnable for the state. It also reverses earlier decisions by both the tax court and the appeals court, which had turned down the case against Thaksin. To understand why the Supreme Court ruled this way and why the ruling matters, we must unpack three core elements of the case: concealment of ownership, the principle of tax fairness, and the court's insistence on legal substance over clever form. This is not a very complicated story, but it is a long story that involves a lot of legal implications. And in the end, the question from now on is how this particular case will affect the political future of the Chinawat family, Thaksin himself, his daughter, former Prime Minister Paetongtarn, and the Pheu Thai party in the upcoming election. But let's get Ping and Pong to dive into how the Supreme Court came up with the decision that overturned the two earlier decisions by the two courts. And that is why it has become a major political, legal, and even social issue. Let's get Ping and Pong to dive into this.
Welcome to the Deep Dive. Today, we are wading into some very deep waters. We're talking international finance, we're talking high-stakes politics, and we're talking about a domestic tax law ruling that honestly has been decades in the making.
It really has. And this isn't just another tax case. This is a saga, really, involving one of Thailand's most well-known and controversial political figures. And it all culminates in this one final verdict that could reshape what tax avoidance even means in the country.
We are, of course, dissecting the final word from the Supreme Court's tax division, and it's a case concerning former Prime Minister Thaksin Shinawatra.
The sheer magnitude of the numbers here is, it's impossible to ignore. We are talking about a final tax bill, and this includes all the penalties and surcharges of 17.6 billion baht.
17.6 billion. Just let that sink in for a moment. It's a monumental claim by the state against one person. And the reason this is so explosive, the reason we're talking about it today, is that the Supreme Court performed a complete reversal. It overturned rulings from two lower courts.
Two specialized tax courts, no less.
Right. And they definitively ruled that Thaksin, the plaintiff in this case, has to pay the entire sum, the full 17.6 billion, all related to that infamous sale of ShinCorp shares.
So for you listening to this, our mission today is to really cut through the incredible complexity here. I mean, this case wasn't won or lost on a single detail. It all came down to these two very powerful legal pillars that the Supreme Court used to essentially look through the corporate maze that had been built.
And what are those pillars?
First, you have the concept of legal agency. We're going to have to get into how a hidden principal, the true owner, can be legally bound by the actions of their nominees, in this case, his children.
Okay, so that's the procedural part.
Exactly. And the second part is the substantive one. It's this powerful anti-avoidance principle in Thai tax law that translates to something like the lack of tax virtue.
Lack of tax virtue. I like that. It sounds almost philosophical.
It is, in a way. It's the court saying they can look past the letter of the law to the spirit of the transaction. And this ruling has so much historical weight because it builds directly on earlier findings, specifically from the Supreme Court's criminal division.
Right. That was the case that had already established that the shares, the ones that were sold, were truly owned by Thaksin and his wife, even though they were registered in their children's names.
So the ownership question was, you could say, already settled. But the tax liability question, that was very much up in the air. Until now.
Okay, so let's start at the beginning of this specific legal fight. Who were the players, and what did those initial court battles look like?
Right, so to understand the final judgment, we have to set the stage. The plaintiff, the taxpayer fighting the bill, was Thaksin Shinawatra.
And on the other side?
The defendants were first the Revenue Department, who issued the bill, and then also the key members of the government's Appeals Consideration Committee, who were the ones who upheld that bill administratively.
So this all started with the Revenue Department sending out a formal notice. I think it was called a FHNG-12.
That's the one. And it demanded that Thaksin pay that huge 17.6 billion baht sum in personal income tax, all stemming from the gains on that ShinCorp share sale.
But here's the first big twist in this story, right? The Revenue Department didn't win at first.
No, far from it. They actually lost. And they lost twice. The Central Tax Court ruled to just completely revoke the assessment notice.
Just threw it out.
And then the Court of Appeal for Specialized Cases looked at it, and they agreed. They affirmed the lower court's decision.
Wait, hold on. Two specialized courts that deal with this stuff all day, they both agreed with the taxpayer. That makes it sound like the Revenue Department must have made a really fundamental mistake.
They did, or at least that's what the lower courts believed. It was this fascinating procedural challenge that's all rooted in administrative law.
So not about the tax itself, but about the paperwork.
Pretty much. The Central Tax Court really honed in on this one specific requirement in the Revenue Code, Section 19. And this section says that the tax authority must issue a proper formal summons, it's called a matriac, to the person they're actually assessing, the true taxpayer, the principal.
And of course, the Revenue Department had initially gone after the children, Pamthongte and Pintongta, so the summonses went to them, not to Thaksin.
Precisely. You see the problem. Even though the criminal court later came out and said, no, Thaksin is the real owner, the principal, the Revenue Department never went back and issued a new formal summons directly to him before hitting him with that final assessment.
And the lower court said that was a fatal flaw.
A fatal procedural flaw. They said, this failure to issue the mandated paperwork to the person you're ultimately trying to tax, it just voids the entire 17.6 billion baht assessment.
Wow. So a massive tax claim, potentially undone by what sounds like a clerical error. Was there any way for the government to argue around that?
Not according to the lower courts. They saw that summons, that matriac, as a critical due process requirement. Their logic was, look, you can't assess person A based on a legal process you started with person B, even if B turns out to be A's agent. They felt the procedural integrity was just completely compromised.
And that procedural argument was strong enough to win twice.
It was, which forced the Revenue Department into their last-ditch effort, a final appeal, a dicta straight to the top to the Supreme Court's tax division.
And that is where the entire narrative just flips on its head, because when the Supreme Court decides to reverse a decision, that's a big deal, especially when you're reversing two lower specialized courts.
It's a huge deal. It's the highest court in the land for this matter, saying, no, both of you fundamentally misinterpreted the law, specifically how tax procedure is supposed to work when you're dealing with facts like agency and deliberate concealment.
It sounds like it was more than just a reversal then. It was a statement.
It was a policy statement.
Yeah.
The Supreme Court was signaling that, the technical, rigid rules of procedure cannot be used as a shield when the underlying facts so clearly show an attempt to avoid tax by hiding the truth. They had to find a creative legal path to bridge that procedural gap. But before we get to how they did that, we really need to look at the structure they were trying to shield.
Right, because the court wasn't just ruling on the procedure. They had to dig into the transaction itself. So let's unpack how this whole nominee structure was assembled, step by step.
And this timeline is fascinating because it shows the long-term planning involved.
Yeah.
This goes back almost a decade before the final sale.
So let's start in 1998. April 10th, to be specific. At that point, Thaksin personally holds nearly 33 million shares of ShinCorp.
Correct. 32,920,000 shares.
Yeah.
Then, less than a year later, in March of 1999, the absolute cornerstone of this entire scheme is created. A company called Ample Rich Investment Ltd.
Ample Rich. And where was it based?
It was incorporated in the British Virgin Islands, the BVI.
Oh, the BVI, a classic choice for an offshore holding company.
It's a classic for a reason. You get a high degree of confidentiality, a regulatory environment that's very favorable for tax-efficient structuring. And crucially, at the very beginning, Thaksin was the sole owner of Ample Rich. He held just one single share, but it was all his.
Okay, so he owns the shares, he creates the DVI company, Then comes transfer number 1.
This happens in June 1999. Ample Rich, his own BVI company, buys those 32.9 million Shincor shares from him. They do it at the par value, which was 10 baht per share, and the transaction is done on the stock exchange of Thailand, the Suthichai.
And doing it on the set is the critical detail, isn't it?
It's absolutely critical because under Thai personal income tax law, if you're an individual and you sell shares on the SETI, your capital gains are generally tax exempt.
So by selling the shares to his own offshore company on the exchange, he legally moved the assets out of his name, and any gain he made personally was tax-free.
That's the move. The shares were now officially held by the offshore entity Ample Rich.
Then we start to see these structural adjustments, and they seem to line up with his political career.
They do. In December of 2000, as he's preparing for office, holding those shares would be a massive conflict of interest. So he transfers his one single share of Ample Rich, which is, remember, the entire ownership of the company, to his son, Thaksin.
So now on paper, his son owns the BVI company that owns the Shincor shares.
Exactly. Then comes an internal event at Shincorp in August 2001. They do a stock split. The par value goes from 10 baht down to just 1 baht. This multiplies Ample Rich's holding by 10. So suddenly they're holding 329,200,000 shares.
The value is the same, but the number of shares just exploded. It's a much bigger pile of chips to play with for the final sale.
A much bigger pile. The final piece of the setup happens in May 2005. Ample Rich increases its capital, issues 4 new shares. Thaksin buys 3 of them, and his sister, Pintongta, buys 1. Now, total ownership of the BVI entity is 5 shares, all held by the 2 children, who are also made directors. The stage is set.
And this brings us to transfer number 2. This is the one that sparked the whole 17.6 billion baht dispute. It all goes down on January 23, 2006.
A very busy day. On that day, Ample Rich, the BVI company now officially owned by the children, sells all 329.2 million Shincor shares to Thaksin and Pintongta personally. They split them right down the middle.
And this is the part that defines the entire case. The price.
The price. They were sold for 1 baht per share, and it was all done through an off-market transfer.
1 baht. The economic gap here is just, it's breathtaking. Because on that exact same day, what was the market price for a large block of Shincor shares on the stock exchange?
49 baht and 25 satang. 49.25 baht.
So you've got an internal transfer at 1 baht versus a public market price of almost 50.
And you have to think about what would have happened otherwise. If Ample Rich, the BVI company, had sold those shares directly on the market at 49.25, it would have realized a gain of over 15.8 billion baht.
Which would have been taxable in Thailand.
Very likely subject to either a withholding tax or corporate tax, depending on how it's classified. But by selling them internally to the kids for 1 baht, they shifted almost all of that inherent value to them for practically nothing. The potential tax bill, it just seemed to evaporate.
It vanished. Because then transfer number 3 happens immediately.
Later that same day, Thaksin and Pintongta, who are now the registered owners of the shares, they turn around and sell those exact same 329.2 million shares to the Temasek Group from Singapore.
At the full market price.
At the full market price, 49.25 baht per share on the S8.
So the children realized the massive gain, but because they were the ones who sold the shares, as individuals on the stock exchange, they could claim the tax exemption.
That's the scheme. Use the BVI company and the 1 baht internal transfer as a funnel to get the gain into the hands of registered nominees who could then claim that statutory tax exemption. It was, on paper, a perfectly constructed plan.
But the Revenue Department, when they finally look at this, they didn't see a perfect plan. They saw a blatant tax dodge.
They did. But their first problem was, who to go after. They were initially just looking at the names on the paper.
So the first investigation, which was kicked off by the Committee Investigating Harm to the State, the KTS, it targeted the registered shareholders, the children.
Correct. The KTS made the argument that the difference, that huge gap between the 49.25 baht market price and the 1 baht internal price, was taxable income for Thaksin and Pintongta. So they issued summonses to the children and hit them with a combined tax bill of roughly 11.8 billion baht.
But then the whole dynamic of the case just shifts dramatically because a different court gets involved.
A different and much more powerful court. The Supreme Court Criminal Division for Political Office Holders weighs in on a completely separate corruption and asset seizure case.
And that ruling was the real game changer.
It was the game changer because it was the first time a court officially proved the nominee relationship. The criminal court definitively found that Thaksin and his wife were the true owners of all those shares, and the children were just holding them as nominees. And that ruling led to the seizure of over 46 billion baht in proceeds from the sale.
So the children, who are staring down the barrel of an 11.8 billion baht tax bill, suddenly have a perfect defense handed to them on a silver platter by the Supreme Court itself.
It's an incredible irony. They went to the tax court and argued, look, the highest criminal court in the land just said we weren't the real owners. If we weren't the owners, we didn't earn the income. You can't tax us.
And the tax court agreed.
The tax court agreed. They revoked the tax assessment against the children. They essentially used the court's finding of concealment to successfully evade the tax liability.
Which, of course, led the Revenue Department to immediately pivot. If the courts now say Thaksin was the true owner and the true earner of the income, then he's the one they should have gone after all along.
Exactly. So they took that same liability, recalculated it with interest and penalties up to 17.6 billion baht, and assessed it directly against him. And that assessment is what he challenged, leading to the case we're talking about today.
But before the court could even get to the substance of the tax, his legal team tried to get the case thrown out on procedural grounds, right? A kind of two-pronged attack.
They did. They challenged both the legal basis for the investigation in the first place and the fairness of the appeals process.
So let's take the constitutional challenge first. What was their argument there?
His lawyers argued that the KTS announcement that started the whole thing and a part of the Revenue Code itself were actually unconstitutional. They cited principles of equality and basic rights from the 2017 Constitution. They were basically saying the entire process of being singled out for this review was illegal from the start.
That's a pretty fundamental challenge. How did the Supreme Court handle that?
They handled it very swiftly. They dismissed it, basically saying this issue has already been decided. They cited a prior ruling from the Constitutional Court, which had already found the KTS announcement to be perfectly constitutional. So case closed on that front.
Okay, so what about the second challenge? The one about the impartiality of the appeals committee. That seems like it might have more merit. I mean, the committee included people from the same department that issued the tax bill.
It's a valid concern. You see this kind of argument in administrative law all the time. But the Supreme Court found that the objection itself was invalid because of a crucial procedural failure by Thaksin's team.
Another procedural failure.
Another one. They pointed to the Administrative Procedure Act, which has a very clear rule. It says if you think a member of an administrative committee is biased or has a conflict of interest, you have to file a formal written objection before they issue their final decision.
And they didn't do that.
They didn't. They waited until after the decision came out to raise the issue in court. And the Supreme Court said, sorry, you missed your chance. You forfeited the right to make that argument.
That's a tough lesson in administrative law. So the court just swept aside both of these big preliminary challenges.
Cleared the decks, which finally allowed them to focus on the single biggest hurdle for the Revenue Department. That missing summons, the issue that had won the case for Thaksin in 2 other courts.
Right. If they couldn't get around the fact that they never issued a formal Montreact to Thaksin himself, the whole 17.6 billion baht assessment was dead in the water.
It was. So the Supreme Court had to find a legal mechanism to make the original summons, the one issued to the children, legally binding on the father.
And how on earth did they connect those dots?
They did it by pulling a principle out of the Civil and Commercial Code. They applied the laws of agency. The court officially confirmed what the criminal court had already found, that Suthichai and Pintonta were acting as Thaksin's agents, his nominees.
Okay, that makes sense. But I'm still not clear on why summoning the agent binds the principal, especially when the principal was deliberately hidden at the time.
Well, this is the absolute crux of the Supreme Court's reasoning, and it's all about something called the undisclosed principal doctrine.
Okay, break that down for me.
Think of the Revenue Department as a third party acting in good faith. When they started their investigation, they looked at the public records, the share certificates, and the names on those records were the children. So when they issued the summonses to them, they were relying on the official apparent state of affairs.
They were a good faith third party.
Exactly. And the law of agency says that when you, as a principal, allow your agent to go out into the world and appear to be the true owner, you can't then turn around and hide behind your own concealment to escape the consequences of their actions with those good faith third parties.
So you're bound by what your agent does.
You are legally bound. Therefore, the Supreme Court ruled the original summons issued to the agents was legally effective and sufficient to bind Thaksin, the true, but at the time, undisclosed principle.
That is a profound reinterpretation of tax procedure. It's basically saying the Revenue Department was not required to issue a new summons.
They weren't. The court essentially patched the procedural hole that the lower courts had found. They used a principle from private law agency to validate a process in public law tax collection.
It's a very pragmatic, almost elegant solution to stop the taxpayer from benefiting from his own act of hiding.
It had to be. Because if the court had insisted on a new summons, the defense could have argued that by the time the Revenue Department got around to issuing it, the statute of limitations or other administrative deadlines had already passed. He could have been protected entirely.
But let me just play devil's advocate for a second here. Isn't the court basically letting the tax authority skip a legally required step, the formal summons to the person being assessed, just because this was a high-profile case involving nominees? Doesn't that sort of undermine due process?
That is the essential tension. And the court did address it. They argued that due process was satisfied because the investigation itself was triggered legally by those original summonses to the nominees. All the information they used to build the case against Thaksin, the document showing the one-bat transfer, the market price data, all of that was gathered legally under the authority of those now validated summonses.
So their position was that he knew it was going on the whole time.
Their position was that Thaksin was fully aware of the assessment process against his children. He was, in effect, directing the defense from behind the scenes. So he had sufficient notice and opportunity to be heard regarding the actual facts of the investigation. The substance was there, even if the form was imperfect.
Okay, so by validating the original summons through this agency principle, the Revenue Department's 15.88 billion BAT income base was now legally confirmed. The procedural roadblock was gone.
It was gone. And that meant the court could finally turn its full attention to the substance of the tax plan itself.
In this next part of the ruling, this is really the core of it all, isn't it? This is what will set the precedent for big tax cases in Thailand for years to come.
Without a doubt. Because the court moved past all the forms and documents and focused on one thing, the ultimate intent of the transaction. They had to decide, was this benefit really taxable income? And was this tax avoidance structure itself even legally permissible?
So first, defining the income, how did they do that?
They confirmed that the benefit, that huge 48.25 BAT gap between the internal sale price and the market price, it clearly fell under the Revenue Code's definition of income, specifically property or other benefit received which may be calculated in money, and therefore it was taxable income.
And since Thaksin was the proven principal,
he was the true recipient of that massive benefit, which the court calculated at 15,883,900,000 bahts.
Now, his lawyers had a counter-argument for this, a pretty classic one. They argued that the transfer from the BVI company Ample Rich to the children wasn't a real transaction at all.
Right. Their argument was, look, all of these entities, the BVI company, the children, they were all just extensions of Thaksin himself. So moving assets between them is like moving money from your left pocket to your right pocket. No real transaction occurred, so no taxable income was generated.
And this is the argument that the Supreme Court just utterly demolished.
Literally. This is where they brought out that powerful anti-avoidance doctrine we mentioned earlier, lack of tax virtue. It's the Thai legal system's version of the substance over form principle you see in tax law all over the world.
And what did that mean here?
It meant the court said, we don't care about the paper trail. We care about the economic reality. And the reality was that this entire scheme lacked any rational business purpose and was designed for what they called a seriously illegal purpose.
Okay, let's break down the specific findings the court used to justify that. There were 3, right?
Yes. The first was the overarching context. They called it concealment for political office. The court explicitly stated that this whole structure with the BVI company and the nominees was created and used for one primary reason. Because Thaksin intended to hold high political office, which legally prohibited him from holding those Shincorp shares.
So the very act of concealment tainted the entire transaction from the start.
It did. The court was saying this wasn't just normal business planning. This was politically motivated camouflage from day one. The purpose wasn't just to save tax. It was to break conflict of interest rules first and then exploit that structure for a tax gain later.
That brings us to the second finding, which seems to be the most impactful one. The lack of economic reason. What does that mean in plain English?
It means that if you look at the transaction through a commercial lens, it makes absolutely no sense, unless the only goal is to manipulate your tax bill. Why would any company, ample rich in this case, sell a hugely valuable asset shares worth 49.25 bait each to related parties for just one bait?
No rational, profit-seeking company would ever do that. You're willingly giving away 98% of an asset's value.
Exactly. The court said the BVI entity wasn't set up for real investment. It was set up specifically to be a tool, a vehicle to execute transactions that were designed only to maximize the tax benefits for the principal. That one bat sale wasn't a real sale, it was just a mechanism, a conduit to get the gain into the hands of the tax-exempt nominees.
So the court is basically saying, we see the paper trail, but we're looking at the reality. And the reality is that billions in value were artificially moved from a taxable entity to a non-taxable one.
That is substance over form, in a nutshell. And the third finding was all about protecting the integrity of the entire tax system. They called it preventing the tax evasion model.
So they were worried about the precedent this would set.
Deeply worried. Think about it. If they had allowed Thaksin to successfully argue, oh, no transaction really occurred because the buyer and seller were secretly the same person, they would have created a perfect blueprint for mass tax evasion.
Anyone with enough money could just set up a nominee structure, move assets around internally for $1.
And then if they ever got caught, they could just say, well, it wasn't a real transaction because I owned both sides all along. It would create total uncertainty in tax collection.
Oh.
So the court drew a very, very firm line in the sand.
They called the whole thing a transaction for a seriously illegal purpose. That's incredibly strong language.
It's powerful.
Yeah.
It doesn't just mean it was irregular. It means the intent behind it was fundamentally hostile to the law and to public order. And that doctrine is what gave the court the power to disregard all the meticulously constructed legal forms, the BVI company, the share transfers, and rule based on the naked economic reality.
Which brings us to the final piece of this puzzle, the tax exemption itself. The final sale from the children to Temasek happened on the stock exchange. That would normally be tax-free for an individual. Why couldn't Thaksin, as the true owner, claim that same exemption?
The court applied a legal principle called strict interpretation when it comes to tax exemptions. They said an exemption is a privilege, not a right, and so it has to be interpreted very narrowly and in favor of the tax authority.
And their interpretation was?
Their ruling was that the exemption for selling shares on the SAN only applies to the true owner, who is also the named owner on the share certificate.
So you have to be both the real owner and the registered owner. Why so rigid?
Because the court connected it back to public trust and market integrity. They referenced the Securities and Exchange Act, saying that using nominees, especially if you're a major political figure, undermines the transparency that the financial markets rely on. Shareholding information is public for a reason.
Right, for corporate governance, for market confidence.
Exactly. So if you deliberately conceal your ownership, you've compromised the integrity of that public system. And therefore, the court said you can't then turn around and retroactively claim a tax privilege that was intended for honest, fully disclosed market participants.
So, in effect, the court punished the act of concealment itself by denying him the tax-exempt status he was trying so hard to achieve.
You've got it. That benefit of 15.88 billion baht was therefore fully taxable income with no exemptions allowed.
And with the procedural issue fixed by agency law and the substantive defense shattered by the lack of tax virtue doctrine, well, the conclusion seems pretty inevitable.
It was. The Supreme Court confirmed that tax base of 15.88 billion baht and ruled that the Revenue Department's assessment against Thaksin was entirely lawful. The judgment explicitly, and in no uncertain terms, reversed the decisions of both the Central Tax Court and the Court of Appeal.
The final step then was to figure out the penalties. Does the court have any discretion there? Can they reduce the fines?
They often do. Tax law usually gives courts the ability to reduce or even waive penalties and surcharges if the taxpayer can show they acted in good faith. You know, maybe they made an honest mistake trying to interpret a really complex law.
Was there any consideration of that here, given the complexity?
Absolutely none. The Supreme Court's judgment found no reason to waive or reduce the fines and surcharges.
And the rationale?
The rationale was crystal clear. This was not a good faith error. This was a deliberate multi-year plan. The transactions were done specifically to conceal ownership, to illegally secure political office, and to structure a plan that lacked tax virtue. Because the entire scheme was rooted in a seriously illegal purpose and had no economic substance, the court brought down the full financial weight of the law.
Which meant the full penalties and surcharges were tacked on to the principal tax amount. And that brings the final bill that Thaksin must now pay to the state to that headline figure.
17.6 billion bahts. And it's important to remember, as the source materials point out, this massive financial liability comes down while he is concurrently serving a prison sentence for related corruption cases. So the judiciary, through the tax court now, has imposed the final financial consequences for the structures he used during that period.
It's a phenomenal legal journey to follow. You have two lower courts that sided with the taxpayer, focusing on a procedural misstep by the government.
A failure to issue a summons.
Right. And then the Supreme Court comes in and deploys these really sophisticated legal tools agency law on one hand, and this substance over form doctrine on the other to completely override those procedural findings. They validated the assessment based on the underlying economic reality and the intent of the entire transaction.
And those two pillars of the decision, they're going to resonate far beyond just this one case. First, using the agency principle to validate the summons sets a huge precedent. It basically tells tax authorities that they can use evidence gathered against nominees to legally bind the true principle. It neutralizes that whole line of procedural defense based on concealment.
And the second pillar.
The second, the decisive use of lack of tax virtue, shows that the judiciary in Thailand is willing to be very aggressive in applying anti-avoidance principles, especially when politics and concealment are in the mix.
So this case really offers a crucial lesson for anyone involved in, high-stakes financial structuring anywhere. The Supreme Court has unequivocally said that these complex legal structures, these international entities like the BVI company here, they will be looked straight through if their main purpose is just to get a tax advantage based on hiding things or on a lack of real economic substance.
The form of the transaction will not protect you from the economic reality.
Which leaves us with the ultimate question for you, the listener, to think about. This deep dive shows a judiciary drawing a very bright, very definitive line in the sand. So what does this decision really mean for the accountability of political figures, not just in Thailand, but worldwide when it comes to the assets they manage while they're in power? And maybe more importantly, how does this ruling permanently recalibrate the risk for any future tax planning now that the courts are armed with this powerful anti-avoidance doctrine of lack of tax virtue? That line between clever tax planning and illegal tax avoidance, it has never been clearer.
Thank you for following Suthichai Live English. Until the next episode, thank you for following. And when an important issue comes up, you will get the English version of the analysis of the current events in Thailand. Thank you.